안녕하세요. 다들 좋은 한 주 보내고 계신가요? 오늘은 지난번 영상에 이어서 크리스 버밀런의 인터뷰의 남은 부분을 나누도록 하겠습니다. 자, 혹시라도 인터뷰 일부 영상을 못 보신 분들께서는 반드시 시간을 내셔서라도 꼭 시청해 보시기 바라겠고요. 제가 10분 정도로 아주 중요한 부분들만 요약해서 편집을 했기 때문에 많은 시간이 소요되는 것은 아니니 반드시 보시기를 권하겠습니다. 정말 내년을 대비하는 데 있어서 크리스가 아주 중요한 인사이트들을 나눠줬다고 생각을 합니다. 자, 그러면 디스크레이머만 듣고 영상 바로 보도록 하겠고요. 여러분들께서 인터뷰를 쭉 보실 수 있도록 인터뷰 중간에 제가 관리할 수 있는 유튜브 광고들은 모두 삭제하도록 하겠습니다. 그리고 제가 진행하는 페이트런 서비스를 통해서 제 장기 투자나 단기 트레이드로 인한 매수 매도 트레이드들, 그리고 보유한 주식을 단 한 주도 팔지 않고 프리미엄 수익을 낼 수 있는 제 커버콜드도 나누고 있으며 줌 미팅을 통해서 차트 분석과 마켓의 움직임, 그리고 눈여겨보는 주식들도 나누고 있는데요. 제 서비스에 관심 있으신 분들께서는 아래 페이트런 링크를 클릭하셔서 함께 했으면 좋겠습니다. 제가 만든 컨텐츠들은 어디까지나 정보 전달을 위한 영상들이기 때문에 절대 영상만 보시고 주식들을 매수 매도하지 마시기 바라고요. 본인 스스로 반드시 리서치를 더 하신 다음에 판단을 내리시기 바라겠습니다.
If you can understand what stage you're in, you know what strategy you need to trade. You'll also understand what to expect from the markets, if it should be a choppy, difficult time, or if it should be pretty smooth sailing. If the moving average, the 150-day is moving up, price is generally above it, you're probably in a stage 2. When price is below it, or the moving average is topping out and moving down, and you're kind of in a mixed signal. So you're either in a stage 3 or a stage 1 type of formation. And then when they're sloping down and prices consistently below it, you're probably in a stage 4 bear market or financial reset. That's why I like the 150-day. I find when you look at a lot of charts and the indexes, you'll find price actually finds much more support off the 150-day than the 200-day. But the 200 days is one of those things everyone seems to use, and they say the golden cross and the bearish cross, which is, when the 50-day passes up through the 200-day. I mean, all those things are it's such an old, slow time frame. I don't like to kind of follow what everybody else does. I like to try and find something usually a bit shorter time frame, and that seems to work consistently through time versus just two moving averages crossing over doesn't mean a whole lot to me. I always talk about the stock market. It's just like the ocean. And if the stock market's going up, you want to be looking to own stocks. If it's going down, there's no point in being diversified and owning all kinds of stocks, because pretty much all boats go down with a falling tide. Well, almost all stocks go down when the stock market is in a bear market. So to me, there's no point in holding something during this phase. You're better to go find a different asset, which the US dollar during this time frame skyrocketed up. And it's a very slow, consistent way to take advantage of the market. So it's important to know, are you in a stage 2? Are you in a bear market phase? I believe we're actually in a very big stage 3 top still. I actually think we're going to come up and we're going to poke to nominal new highs, but overall, it's probably going to be a major, major double top. And then we're going to see the stock market, I think, sell off very big down the road, but one bar at a time. I don't try to pick tops or bottoms. That's the nice thing about technical analysis is instead of just trying to trade chart patterns and pick tops and bottoms, I literally just let price tell me which way it's going. I look at a lot of different things, intermarket analysis, a lot of different markets and commodities are related in some way. And if you can see if money's flowing into stocks or into different assets, you can tell how much momentum there is behind it. So a lot of times we actually sit on the sidelines avoiding a lot of the daily noise and chop that people usually get caught up in. And they get so emotional. Literally, people watch the charts every day, tick by tick. They refresh all day. They are so hypersensitive to the tiniest little piece of news and the fear that surges through their veins and their frustration, and they don't know what's going on. I mean, the worst thing they can do is watch the charts and listen to the news. So that's kind of my take.
So during 2023, the Magnificent 7 or 10 tech stocks did rally, and I think that's why the market did really go high. But I do understand that there's a cycle of money, or the money transfers from this asset to that asset, and there's a cycle. And was wondering if you think the institution will keep piling money into the big tech stocks that are rallying right now with a lot of hype in the news, or do you actually see that the institution money is transferring to another sector right now and will happen in the first quarter of 2024?
I would almost think a lot of institutions, big money players, I think we're going to see year-end window dressing. So the technology space, for example, this is the tech sector. It is actually actually already broken to new all-time highs. It broke through it. We had a bit of a pullback in July, and now it's breaking back up and it's hitting new all-time highs. So what we see with a lot of funds and advisors is they have a lot of their clients in the wrong positions, and they haven't kept up pace with everybody else or with the overall markets. At the end of the year, we start to see a lot of the poor performing assets get sold down, and they're going to rotate their clients to hold the tech sector, big tech companies, so that at the year-end analysis, when investors get the report, they'll be like, my account didn't do very well, but I have all the big stocks that perform the best, so I must have done the same as everyone else. And it's called window dressing. You just kind of pull the wool over everybody's eyes. So we could very easily see more money start to roll into these big techs, because a lot of advisors are going to shuffle everybody over. So, the clients think that they've already held all these, they've done just as well as anybody could. So that, I think, is going to drive the market higher. And then when we hit these new all-time highs, I feel like that's when we're actually going to see some big institution. We're going to see huge selling volume. We're in a bullish phase right now. It's not a really strong bull market. It's not a broad market rally. It's just tech is rallying, but it's holding the indexes up, and you might as well ride it until we see that reversal and things. And that's when they're going to start having big thumbs on the sell button and big block orders going through. But I think the big institutions will be riding this up, saying, we're going to be able to unload at a great price when once this momentum starts to stall out and a top starts to get put in.
Chris, this was a lot that you covered with the charts and the economy, and I really want to thank you. But before I wrap up this interview, I would love to hear more of your strategy on asset revesting and how you are actually helping your members or your subscribers.
Yeah, so asset revesting, like the core premise of it is we only hold assets that are going up in value. So I don't believe in the buy and hold strategy, because simply if you have a diversified buy and hold strategy, first of all, if you just hold through everything, it's going to be one wild roller coaster. If you're close to retirement or retired, the last thing you want to go through is a 5 or 10 year market correction and you don't really make any money and you watch your value go down. So I think the buy and hold is just a dangerous roller coaster. The older you get, the more dangerous it becomes. And I don't believe in diversification, because if you diversify across everything, then you're going to have all the stuff that's doing really well, but then you're also going to have all the stuff that's just doing terrible. And so you've got big losers, you got big winners, and they net out to give you that really poor average annual return for the buy and hold investor, which is, depending on your time window, it's like 4 to 8% return, which isn't the greatest. You can do a whole lot better if you literally just move into an asset class that's moving up and manage that position, lock in gains, move your protective stop up. And when it starts to show signs of weakness, you move out and you move into a different asset. And so asset revesting is, we've got a hierarchy of positions. So the most volatile asset is at the top. So it's like the US stock indexes. If they're favorable, we want to own them because they have the most liquidity, the most volatility. They're a nice big basket, and we can play those ocean tides. So we would move all of our portfolio into the equities market. If they fall out of favor, they're going down, then we move to a slower moving asset. Could be US treasuries, which haven't been in favor for a while. Could be the US dollar index ETF, which is super slow. If you go from volatility, stock market, say, is the top volatility, bonds is like half of the volatility of the stock market. And then the currency is like about half of bonds. So as the market gets crazier, we're moving to slower and slower moving assets, and we're moving to different assets. So I think what a lot of people don't understand is, if you own 100 stocks and people say, oh, I'm diversified, I got 100 stocks. I'm like, actually, if that's all you own, you're actually not diversified really at all. If you own stocks, that is one asset class. Bonds is another. Currencies are a different asset. Real estate is another. And so all these people have this false understanding that they think owning 150 stocks and all these crazy sectors, they think they're diversified. And it's really all they're doing is putting these faster moving, highly leveraged positions in their portfolio that when things go south, they actually lose a lot more than if they just stuck with the index. So people are loading up on very dangerous portfolio positions. So that is the one thing that I don't believe in, is the buy and hold diversified stock and bond portfolio. And then there's the other extreme, which are active traders. And there's numerous studies that say if you're an active trader and you trade for 300 days or more, even during a bull market phase, 97% of people lose money. This is across North America, Taiwan, Brazil. They've done multiple tests. Emotions get in the way. People just don't know how to manage risk and money. I've talked about it many times. There's no interest in people talking about money management, like position management, risk management. They all want to just swing for the fences. They pick a random number to throw into an ETF or stock, and they don't understand the risks by doing that. So the more you trade, the more likely you are to lose. If you do absolutely nothing, you're going to have average, crappy returns. You might not have the money when you want it later on in life. It's a roller coaster ride. Asset revesting, is right in the middle. We do like 5 to 12 portfolio adjustments a year. We're in one ETF at a time. It doesn't get any easier. And we literally just are moving into assets that are going up in value. If nothing meets our criteria, we move into an ETF called BIL. BIL is the symbol. And we just collect daily interest. So while the world's falling apart, we're sitting in interest, building our account day by day, waiting for that next set of waves to roll in that have a clean, high probability position for us.
Chris, thank you very much for your time today and your great insights. I think it was very helpful for me, and I think it'll be helpful to a lot of my subscribers that are watching this interview. So thank you very much. And, in 2024, I really look forward to talking with you again about the market.
Great. Well, appreciate it. It's always a pleasure to be on your show and share some insights. Hopefully everybody finds it helpful and learns something.
All right. Thank you, Chris.
All right. Take care. Bye-bye.
Bye.
조금이라도 도움이 되셨다면 주위 분들과 나눠주셨으면 너무 고맙겠고요. 구독과 라이크를 해주시면 더욱 감사하겠습니다.